global trade's priced in dollars, that's a disconnect that's about to change. So not only that, but you have to attract all these buyers. How do you do that with a currency that's depreciating? All of a sudden, our interest rate differential premium over places like Europe and Japan don't compensate you for the currency risk and the bigger picture macro risk of having to pay higher yields. In other words, you have to lower your prices, okay, by paying higher yields to investors to make that 11 trillion in bonds appetizing enough for people to buy them.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we have Greg Weldon of Weldon Financial, who is a veteran market analyst with over 30 years experience in commodities, macroeconomics, and monetary policy. Known for his sharp insights and data-driven approach, Greg delivers powerful analysis through his Weldon Live reports, guiding investors through today's volatile and complex financial landscapes. Greg, thank you for coming on the show.
My pleasure, Steve.
Pleasure's all on this side of the table, sir. I'd like to start out with my first-time guest. This is your first time on the show, so go ahead and tell us your story, how you got into investing, and how that led to where you are today.
Wow. I mean, that's a long story, man. You got 3 hours because, I've been in it a long time, 42 years. I played Division I college basketball at Colgate University. I was 6'10", 300 pounds. Got beaten out by a well-known NBA player, for the Philadelphia 76ers. I was looking to go play in Europe, actually, in Portugal. And it just so happened, a friend of mine from high school, it was his birthday. This was in the summer of, 1984, actually spring of 1984. And I decided I want to take him out for his birthday. He was working on the Florida Commodities Exchange at the time. I knew nothing about it. I went to school for, English literature. I was going to play basketball, so I'm a science and math geek. So I really didn't, I didn't know anything about it. And I went to visit him at the World Trade Center on the trading floor. He brought me down on the trading floor while it was still open. Trading's going on, piles of paper, no technology. I mean, you're talking paper, fist fights. I mean, it was insane, right? So he's now, the market closes, we're getting ready. It's a Friday. I'm taking him out, for his birthday in New York. And he has to finish his little write-ups before we leave. So I'm standing there right next to the silver pit. And this gentleman comes up to me. He's about 6'4", in his 70s, okay? Which, for that generation, that's tall. And he starts, he asks me, what I'm doing. And then he tells me he played college basketball at the Garden when NYU was big and 6'4" was tall back in the 40s, right? And so we had this really nice conversation about basketball. And, so 10 minutes later, my friend's ready, says, okay, we're going to go out. So we're walking across the trading floor, which is massive. I mean, it was an auditorium, it was a stadium-like scene in terms of the size of the place. And I said to him, man, this place is great. How do you get a job down here? You don't go to school for this, at least back then you didn't. And he goes, you got to know somebody. I go, you've been down here for 2 years. Don't you know anybody? He goes, that guy you were just talking to owns the largest firm on the floor. And this is like life-defining moment where he planted my foot, did an about face, and went back and asked the guy for a job. And he actually hired me on the spot because of my size, 6'10", 300 pounds. I could hand paper over people. I could see over people into the back of the booth. And so I got the job, for reasons that these days wouldn't apply necessarily. And so I came in cold. Now, the story is a little long, but it's pretty interesting because, so I quit my job I was working telecommunications at the time to make some money. And I called my boss from the booth, right? And they had this huge booth that goes way back away from the ring and banks of phones. And I called him, quit my job, come in the following Monday. The guy takes me out, Stanley Bell was his name. And he takes me to we watch the market open. He tells me what's going on. You got the ARP phones, you got the landlines that go to China, that go to OPEC, that go to London, so on and so forth. Lays out, what the brokers are doing in the whole 9 yards of kind of what's happening. I still have no clue because it's complete chaos. All right. So he says, okay, it's maybe an hour and a half into the opening. And he says, okay, let's go to breakfast. I want to talk to you. So we went up to the members thing way up by the windows on the World and World Trade Center. And he told me, he goes, there's 3 ways you can make a lot of money in America. You're either an actor, a professional athlete, or you do what we do. And that kind of won me over, and I said to myself, look, I can go chase this, this pipe dream to make the NBA, go play in Portugal, get paid $30,000 to be there for 6 months, which was a lot of money back in 1984. Or I could take this $13,000 a year job year round, 12 months, and learn something. And maybe I could do this for the rest of my life. So this is why I decided to stay. So 11:30, and he tells me, okay, you've seen enough for the first day, go home. okay, quite the antithesis of some of the movie scenes you see with Matthew McConaughey. But okay, so I go home. So I come in on the Tuesday. Now, Stanley's only there Monday, Wednesday, Friday. All right. He's like semi-retired. Nobody knows what to do with me. So they sent me downstairs. Now, Stanley's one son ran the trading operations, was the main silver broker. And his other son ran the downstairs operation where all the trading actually took place because it's all paper. We'll come downstairs and match it off. And, that's where the fist fights were. It's like, you said buy. No, I said buy. So we're maybe an hour in, and all of a sudden the ceiling where the seventh floor is the trading floor, the sixth floor is the write-up room, starts to shake. And it's like people now starting to run around. I see people running up and down the stairs. Like, what's going on? The phone rings. And the other Bell brother picks up the phone, and all I hear is, get that big mofo up here now, right? Screaming. Well, what happened is day two, which is really day one for me, Continental Bank in Chicago failed. And it was one of the biggest bank failures in U.S. history at the time. And the markets went crazy. And they brought me up and put me in the point. This is a company with 30 employees, right? I overstepped 26 of them day one because of my size to get into point because I could hand paper and it was chaotic and I had no clue what I was doing. So my introduction was trial by fire. And I fell in love with the markets. I'm a math guy, so started technical analysis, worked at Lehman, worked at a couple of the big hedge funds in New York linked to Tudor Jones and the Bacon brothers. I don't know if you know who they are, but they're legendary. Louis Bacon, probably the greatest hedge fund trader of all time. He was my mentor. And Commodities Corporation, venerable trading firm that no longer exists. And then I went on my own in 1998 and been doing it ever since. So, it is global top-down macro, it's technical analysis, it's quantitative because I'm a math guy, and it's psychological too. I mean, everything is involved. When you learn how to be a trader and a money manager, it's a journey of self-discovery. You learn yourself and you have to master yourself. And it's kind of like you have to get over the ego of it and being able to take a loss. And I liken it, I heard this analogy once a long time ago, and I've always repeated it. It's like, look, if you're a baseball player, you only have to be successful 1/3 of the times to be an all-star Hall of Famer. And that's kind of the way you got to look at it. It's like you might fail a lot, but that doesn't necessarily mean you're going to fail. So again, it's kind of an ego thing that you have to learn and deal with, or you're destined to failure and ruin. So it's
Wow.
a valuable lesson overall.
What a story.
Yeah,
You just fell into it because of lucky
good.
with height.
Yeah.
And that
Knock on wood.
spurred your interest to what you got today.
Yep.
That is pretty cool. Pretty cool. From basketball to commodities exchange.
Yeah.
Okay, let's branch into macro economics. What is your macro view of the world economy and financial markets today?
Yeah, well, there again, this is the macro secular story that we really have to take back to 1971. All right. Going off the gold standard is when the whole credit bubble that we have now started. And to me, it's 78, 79 into 81, 82 were key, and 85 were kind of the key triggers. What happened in 78, 79? Paul Volcker defeated inflation at the time big. You remember the 70s, oil embargoes and Carter and wage price spirals and all this kind of stuff. So Volcker comes in, he defeats inflation with draconian interest rate hikes, 20% short-term interest rates. It was kind of insane. And then you had from that point, then Reagan gets elected. And now you have a kind of a U.S. spiritual revolution. And you have Reagan now starts to spend so he can win the Cold War. He spends on Star Wars. He spends on defense. He does all these things and reinvigorates the economy. Now you have Jerome Powell. Now, okay, forward fast, 45 years. You have Jerome Powell. He is a Volcker disciple. In 2018, when Jerome Powell became the Fed chair, Jackson Hole's speech followed quickly by the Fed publishing 11 white papers, over 300 pages in total. I read every word of them. And it was the new monetary policy paradigm where we're going to let inflation run, then bring it down with higher interest rates and hopefully keep it at an average rate that is sustainable around 2%. And they have actually done everything they said. Now, you might say COVID caused all this. That nothing could be further from the truth. This was happening already in 2018 and 19 when you had the economy started to roll. The Fed was already easing. You're already on a path to get QE, and then COVID hit and blew it up. So it became nuclear because of COVID, and it happened much faster because of COVID, but this still would have happened without COVID. That's key to know. So now let's go back to the early 80s. All right, in the context of all that we just talked about, you also had in 1985, and I remember the day getting on the train Monday morning here in the Plaza Accord had been signed in New York, where G20 and G7 had agreed to devalue the dollar. This is huge. So if you look back and what you have is this credit bubble that started because you had no debt. All right. So now you're able to expand all this debt. You have a dollar depreciation that, is not causing inflation because you're able to spend all this debt to keep the economy going. So you have GDP running, and the times you've had inflation, largely energy based, but GDP was always outpacing inflation. So you get to the point though, okay, where you see everything change in 2008. 2006, I wrote my book. It's called Gold Trading Bootcamp. And in that book, I suggested, in fact predicted, that the Fed would ultimately be forced to monetize U.S. Treasury debt by printing money. And they would have to flood the system to avoid a recession in the housing market and to save the consumer. Ends up, they also had to do it to save the banking system in 2008. But what's funny about it is 2007, I did kind of a book promotion tour, and I was a regular on CNBC for 25 years. And I get on a Squawk Box and, give this thesis. Gold was trading around 375, 350, 375. And I was bullish. I thought it could go to 1,200. And I just remember saying, the Fed's going to print money and gold's going to, triple in price. And Joe Kerner looked at me and called me a nut job on national television. So it's kind of interesting that 18 months later, everything I said was going to happen happened. And I did run into him in the men's room at CNBC in subsequent years, and we had a nice conversation about his diss of me on national television at 6'10" at 300 pounds. Yeah, he wasn't about to argue with me. But nonetheless, the point is, this changed everything. And why? Because of one of the charts I sent you, which shows debt versus GDP. And we talk about debt, we're only talking about public debt, which in fact is the debt of we the people. It is public debt, okay? And the amount of public debt that the public holds is 80% of the public debt. So the Fed prints these bonds, sells it back to us, and vows to pay us back with dollars that they're devaluing every day by printing more of them, okay?
Is that the one?
It's somewhat perverted. Yeah, that's the one.
Okay.
No, that's the consumer. Let's talk about that one in a minute. Where's the other black hole?
Oh, okay.
Because you also have a consumer black hole. Yeah.
That one?
Bring that one up. There you go. So you can see that between 1970, when debt started to rise because we went off the gold standard, the green line being U.S. gross domestic product. In other words, the economy and growth in the economy. The red line was public debt. Well, you can see after the tech bubble crash in 2000, what happened? Public debt accelerated to the upside. What happened in 2008, 2009? It accelerated even more to the upside and caught up to GDP. And what happened during the pandemic? It exploded, and it is now far beyond GDP. Now that's only the 36 trillion public debt. Okay, again, we the people's debt. But throw in the 18 trillion in household debt, which includes 5 trillion in consumer debt and 1.4 trillion in credit card debt. Add that to the 36 trillion. You're talking about debt that is 186% of GDP. Now, this is a kind of an easy way to put it, but it's not inaccurate to say that to some degree, this means you have to create $1.86 of new credit to create $1 of new GDP growth. Wow. And you need that GDP growth to service the debt. Now you're in this cycle on the little rat wheel where you can't get off it. You're in the debt black hole. If you know anything about physics, I'm a science and math geek, like I said, I'm a total physics nut, right? And when you talk about the black hole, it's like when you cross the event horizon, you're in the black hole. You don't know it, you don't feel it. The gravitational pull is not enough to rip you to shreds yet, okay? But you're in and you can't get out. Well, that's the macro event horizon, is what we crossed really in 2020. And in this case, we will try and get out, okay? And we'll burn all kinds of propulsion to get out. What is that propulsion we're going to burn? Printing more money. We're going to burn money to try and get out of this situation, or at least stay alive in this situation to make sure that this, gravitational pull, this debt dynamic, as we've seen in so many countries throughout history, rips the economy apart. So this is kind of where we are now as a basic tenet. When you compare this one, if you throw up the 40-year bond market chart, okay, and people ask, why is it different now with the bond market? Why is the bond market particularly at risk here and in harm's way in terms of its own crisis? Because of all the debt that we have to perpetually refund, right? And the only way to do it is to keep the economy going, and the only way to do that is to continue to print more money. Thus, we've gone from a 40-year downtrend in interest rates and inflation to a trend reversal and a new uptrend on a secular basis. In the near term, there's $9 trillion of US debt that out of the 36 trillion that is set to mature in the next 12 months. Not only that, you have 1.4 trillion of the 1.9 that you need to borrow from the public in this fiscal year that they left for the last 6 months of the year. So in total, you have you have over 10, you have almost 11 trillion in debt to basically fund or refund in the next 12 months. And here the market was celebrating with this tiny little rally in bonds yesterday. The fact that we sold 39 billion in debt, we're going to be looking to have to sell like 850 billion a month over the next 12 months.
Wow.
I mean, if you don't think that's going to push bond yields higher to the point where it puts the economy and the consumer particularly at risk, you're not really seeing the bigger picture. And what does that mean? It means to me that in the next 12 months, you will face a situation where the Fed will be forced to acquiesce to this higher inflation rate. Because inflation is, disinflated. It's still well above inflation, particularly above the target rate, particularly in services. And the piece I'm just working on for my clients today shows this. I mean, it's pretty dramatic when you look at service inflation versus energy, which is keeping inflation rates lower than they might be otherwise. And all of a sudden, crude oil broke out yesterday. So now there's a whole nother monkey wrench into the thing. But the bigger picture dynamic to keep in mind here is that they will have to print more money probably to save the bond market or to save the consumer down the road. And we can certainly talk about the consumer at length, as a whole separate topic.
Okay, so yeah, I've been seeing on the charts too that it looks to me like yields are going to go up, right? And that's just my TA brain going like, okay, the chart's going up. You're saying the reason is because they have to roll over $9 trillion worth of debt in the next 12 months.
And they have to do it at a time when you're pushing investors, foreign investors away.
Yeah.
I mean, so that's kind of a difficult proposition when you're saying, if you come to us, we can seize your assets if we don't like you. I mean, the trade tariffs, the dynamics around the potential creation. And I still believe very much that this is going on behind closed doors in private, on an urgent basis to create a BRICS unit to get away from the dollar. Yeah. China is 3 to 2 times the size of imports and exports on a monthly basis than is the U.S. And global trade's priced in dollars. That's a disconnect that's about to change. So not only that, but you have to attract all these buyers. How do you do that with a currency that's depreciating? All of a sudden, our interest rate differential premium over places like Europe and Japan don't compensate you for the currency risk and the bigger picture macro risk of having to pay higher yields. In other words, you have to lower your prices, okay, by paying higher yields to investors to make that 11 trillion in bonds appetizing enough for people to buy them.
Yeah.
So this is the, and not only that, but throw in another kind of less talked about, but simple fact. Over the last 12 months, 24 months, the 60-40 stock bond model has gotten destroyed. Yeah. So even the U.S. public, who's the largest buyer of bonds, is buying less potentially. Foreigners are selling. Who's left to be the buyer? The buyer of last resort, always the Fed.
The Fed. Okay. What are some of these other charts that we got here? Which one should I pull up next? You guys
throw up the consumer black hole, the one you put up first, because you get a lot of these guys on TV, and it's funny, I used to be one of those guys for 25 years, but it used to be a lot more double-sided, two-sided. You brought opinion, you brought people that were actually managing money and other things and doing, besides all these people that are stock money, really Wall Street stock market money managers, okay? The big players in the business, all right? They have a perpetual, disposition to want to be friendly to the stock market because that's how they make a living. I mean, it's really that kind of, it's become that, kind of perverted almost to the point where all these guys go on there, and you even have, especially the bank CEOs of some of the really the go-to for Bloomberg and CNBC as to how's the consumer doing? Healthy. I heard one guy say robust, strong. There's nothing that's further from the truth right now. That is only based on credit card receipts that the banks hold. Bank of America is the biggest one. They own several credit cards. You got Capital One too. These guys come on and tell us how rosy it is for the consumer. Why? Because they're seeing all the credit card transactions. The problem is the consumer is living off his credit cards because he can't afford to pay the bills if he's not. And there's a variety of ways to look at that. Number one, personal income versus consumption spending. Okay. It's the PCE data that we get. So
spending is red here, and then disposable income is blue.
Yeah.
Okay.
Yeah. For the last 40 years. Okay. Income's been higher than spending.
Yeah.
Until when? until just after the pandemic.
Yep.
And all of a sudden, because of inflation, you have to spend more to get the same amount of stuff. Now the consumer's in a black hole. Now, if you bring up the other one that is also looking at, consumer savings, which have been drawn down tremendously. You had over 6 trillion in savings at the peak of the pandemic because of all the money being flushed to consumer. That's all been spent. And when you look at this, one of the only times in history where credit card debt has been higher than US savings. Okay, you go back, it was the period right before 2008. And I remember back then, 2006 and 7, when some of the macroeconomists were really warning on the fact that savings were too low and savings were too low. Everyone said it doesn't matter, it doesn't matter. Well, it doesn't matter until it does. And then it matters hugely. And we're kind of in that same situation now. Then you take it to the point where, you could say, well, wages are pretty good. They're at 3.5 or so. Well, doesn't include inflation. All right. So your real wage growth is less than 1%. Then you talk about, well, okay, retail sales have been strong. Retail sales don't take into account price changes. In real terms, retail sales have been deflating for the better part of almost 3 years. I mean, on and off, and really for several long strings, pure deflation on a real basis. So when you take all those things into account, and you take into account the fact you've seen these credit card borrowings just skyrocket, the next thing you got to look at is delinquency rates. The rate of credit card borrowers that were 90 days or later with their payments is the second highest in history. The only other time it was higher was in 2009, just before the entire thing imploded. All right. If you bring up the other chart of revolving credit, all right, then we can even take Powell and go back to Volcker. When Volcker was raising rates, he was very careful in his Humphrey Hawkins to say one specific thing. I don't want to create a credit crunch. We don't need a credit contraction. That would be the worst thing that could happen. Oddly enough, Powell and Yellen have both said we wouldn't mind letting credit contract a little bit. And it's kind of like, are you crazy with all this credit, with the reliance on credit and the degree to which that supports the economy? That's like letting the wrong genie out of the bottle. You might want to let the inflation genie out of the bottle under certain circumstances. Not saying that's the right thing to do. It's the only thing to do. You don't want to let the credit crunch genie out of the bottle, and it's out. All right, because the consumer is saturated, the consumer is unable or unwilling to borrow more, and this is a big problem going forward for the economy. When you look at the times when revolving credit, which is mostly credit card debt, has been falling on a dollar basis on a rolling 12-month measurement, I mean, there's only 2 times: the global financial crisis and the pandemic. And now, this data is telling us, yeah, it's some give back from the huge gains. It doesn't matter. The fact is that revolving credit is deflating, and that's a big problem. So you tie this all together. Don't expect the consumer to bail out the economy. And you can talk about AI bailing out the economy. AI is not enough yet to be at the consumer level. We have companies that are making sales of AI products that are producing profits. That's a step or 2 away. So you can't rely on some of the things we've relied on in the past. Okay, it used to be in the 90s was the Asian tigers, Thailand and Malaysia and Singapore, all the places that are now mainstream players. And then through the 90s, of course, it was all technology driven too. In terms of the internet, price discovery was a big part of the disinflation trend. All right, now it's totally different. China, we're relying on China is going to bring up domestic demand. That's going to serve all these U.S. companies. It's going to help our growth. It did for a while. That's not a factor anymore either. Where is the growth leadership? Where's the engine of growth in the U.S. for the economic growth going to come from? I kind of fail to see it. And I think that's a problem for the Fed they're going to have to address, along with the potential for a bond market crisis, let alone, the situation that we have in Los Angeles that could spread to other cities and already is. I mean, this is kind of a perfect storm for a lot of these markets. That's not to say it's bearish for stocks, though. It's bearish for the dollar. That's the key, all right? And a dollar bearish scenario is not bad for stocks. It's actually positive for stocks. The problem with that is stocks don't keep up with the decline in the dollar. So, on a relative value basis, you're still losing.
Okay, let me just make sure I understand this. So this chart right here is showing that this blue is basically
Yep.
credit card loans, right? And this
Correct. Outstanding. The balance
this
is
gray
outstanding.
right here is American savings. And so we can
Correct.
see that American savings spiked right here because they decided to print a bunch of currency and hand it out to everyone. So here they've spent it now is where we are.
Yep.
It's
Yep.
dropped off a cliff and credit card loans have gone up, right?
Yes.
Okay.
And this is only in terms of the Fed's consumer credit cards. All right. You also have revolving credit, which is even higher. And if you just take this, I mean, you're talking about savings not even being 80% of credit card debt, let alone household debt, which is $18 trillion. So how do you expect the consumer to continue to expand spending on discretionary items going forward? And especially at a time when I see the dynamics, and we've been tracking inflation for the last couple of years extremely well, because there's various ways you can kind of there's tells in inflation data. There's tells in a lot of these data. A lot of the data people say are flawed and all this stuff. Hey, the data is what it is. They tell you exactly how it's compiled. You know exactly what it means, and so you take it for what it is. And I see a lot of signs that inflation starting to turn higher. And if energy breaks out, which it did yesterday, and I think will continue to do, because from a long-term technical perspective, it looks really good here. That's another big problem, man. So, I hate to be a doom and gloomer, because it's not all doom and gloom. There's tremendous opportunities out there from all of this in the currency world, being short some of these bond markets, particularly in the US at some point in time, and more so in some of the commodity markets.
Okay, I'm going to share my screen here on, you mentioned energy. So this is just WTI. But
Yeah.
here, let me zoom in on the daily and then we can see what you're talking about. So oil is up now
Yeah.
around 68, just shot up right there. This yellow line is the 200-day moving average. I was
Yeah.
actually thinking about running a short on this
Mhm.
around $65, and glad I didn't because
Yeah.
it blew through that. What do you see
Well,
here?
if you were going to get short, that would have been the right place to do it. It's just, to me, it's kind of one of those things that if you really look at the supply demand fundamentals in the US for oil, it's bullish. I mean, you have inventories down, first of all, 3 weeks in a row, 30 of the last 52 weeks. You're talking about being well below the 5-year average. The annual deficit and the 2-year deficit have deepened in each, since the beginning of the year rather dramatically.
Yeah.
And this is despite the fact we have record domestic production. So, I mean, this is a pretty bullish setup if you have any situation overseas that could be, trigger any kind of dynamic, that would be very bullish for oil, particularly Iran. I mean, now Iran says they're getting closer to its capacity. Trump wants to stop them. Israel's not going to let them get there. Something's going to give here, and it's going to be the oil market. And the context of the oil market that is also important to note is that these swap rates are making new highs in many cases. And what that means is there is already fear, even though the price is still relatively low, in the swap market, there's already fear that by August, September, you may not have enough physical supply available for delivery to meet demand. And that's a big deal. And that's assuming declines in demand. So you want to talk about something that might be somewhat, never always or never fully, recession proof. Right now, it might be the oil market because it's kind of priced in lower demand, and that lower demand may not even materialize.
Interesting. Okay. All right. So you saw the same 65. If you're gonna
Yeah.
buy a put, that was probably the place to do it. But you see that we might be going higher here, just because all it's going to take is some black swan from the Middle East, and then this chart go up.
Not necessarily. I mean, the lower dollar also helps. And this is where
Oh,
you start to look at a bigger commodity picture. Okay. Two
okay.
weeks ago, we gave a recommendation. In my research, we give specific recommendations in foreign exchange, global bonds, global stock indexes, ETFs, precious industrial metals, ag commodities, and energies. So one of the things that I had put out there just 2 weeks ago was the platinum group metals, platinum and palladium,
Yeah.
rhodium as well, not easy to trade.
Here's
So I
here's
put out a
platinum.
platinum recommendation, yeah, at 970. I mean, it's exploded since then. All right. Silver might be next to go. All right. Because, people like, well, the platinum gold spread got to record lows. The gold silver ratio got to levels that people thought was insane, and there must be some kind of conspiracy going on. Right. But what they're failing to understand is that the buying in gold was not US dollar decline based, because the dollar's been strong, makes the fact that silver has held above $30 in the face of a stronger dollar. Silver's relative performance, when everyone's bitching about it, has been phenomenal.
Yeah.
And now that the dollar's breaking down, it changes everything, because the buying of gold, like I said, has been central banks preparing for BRICS, dollarization, getting out of dollar assets. They sell bonds, they take the dollars, they buy gold. It's really that simple. From Poland to Japan to certainly China. We've seen this, Brazil. All these countries are doing this right now. So people are like, well, silver is, why is silver not moving? Why is platinum not moving? Why are the spreads so out of whack? Because central banks are not buying silver, platinum. Gold is a tier one asset. Gold is a back for the BRICS unit, that they're buying gold. All right. But you haven't seen U.S. speculators buy gold. All right. Open interest in the futures contract is very low. You haven't seen Wall Street money managers rotate capital into gold shares. No. All right. Gold shares it's only now happening. And gold shares are finally breaking out. All right. Because the dollar's breaking down now. Metals like platinum, palladium, silver, all these come into play. So we got bullish on platinum. That was a really good call 2 weeks ago. Still really like it here. And the other one, too, that you might tie back to crude oil, to some degree, is uranium. All right. Now, that is a very bullish story going really far out. You're talking 2028, 29, when it really gets dicey. The market's kind of starting to discount and anticipate that. But you saw the second the dollar cracked, what did the URA uranium ETF do? It skyrocketed to a new 12-year high, which it made yesterday. So this is a kind of a bigger picture thing. You look at some of the commodity indexes, and even within the inflation numbers yesterday, I thought it was interesting. Food always leads the core rate. So you have food against X food and energy. Energy is the only one of the four main components that's below target, and it's actually negative. All the other three main components of CPI are above 2%. Right? When you take that and you apply it to the dynamic around food, it's 2.9, up from 2.7. It had actually gotten below 1% year over year at one point. You can kind of see how food leads the X food and energy component and just cross back above. Is this as if this was like a moving average crossover dynamic? I'll send you today's piece. You'll see what I'm talking about. Okay. Where you have the rate of change in the food price moving above the rate of change in the X food and energy CPI. That's always a tell of higher inflation. Just as it is when it goes the other way, always a tell of lower inflation. It's worked in 2020, 21, 22, 23, 24, and now looking to work again in 2025 as a leading indicator for inflation. And food inflation is something you can't fight with monetary policy. And you have a situation here with the environment that is based on macro secular physics that are biggest picture, 25,800 year cycle of the solar system to the Milky Way. Where we are right now is highly electrified, highly polarized, highly intensified. You see it in everything. Animals acting out, human beings acting crazy, the weather being crazy. Everything's polarized and divided. This is not a coincidence. This is not a one-off. This is not some phenomenon out of nowhere. This is pure physics, and it's going to intensify. And it's specific in terms of the weather and its impact on food and agricultural commodities. So you want to keep pace in the future. Not only will you not keep pace by being passively indexed to stocks, because they won't keep pace with the depreciation in the dollar, food will be a place where you'll want to have some involvement in some of the agricultural commodities to try and keep pace, because you see some of the moves that have already taken place in the last 24 months. Cocoa, triples, record highs. Orange juice, triples, record highs. Coffee, triples, record highs. You're going to see more of that because of the environment we're in that's basically going to continue now for dozens and dozens of years.
Okay, let me go back to gold here. Okay, here's the gold chart. We got a question, listener question from Boy Wonder. He says, question pertaining to gold. Would you please ask Greg how he thinks the Basel III global banking regulations reclassifying gold as a tier one asset going into effect July 1st might affect gold prices for Main Street investors? Thank you to both.
Already has. I mean, that's part of the reason you see this run. I mean, the fact that this is going to be a tier one asset now plays into a BRICS unit. It plays into all the central banks wanting to dump dollars on whole gold. And it's a good question. And it's a question that the market has kind of already answered. So, and I think that only continues. When you look at the BRICS unit, it's like Trump threatened and all this dynamic around, what happened after Trump got elected. It kind of got put on the back burner. There's no way it's on the back burner. Not in reality, not in the back rooms, not in, in secret, or as it were. And I'm a conspiracy guy, but not a conspiracy guy, if you kind of know what I mean. And in this case, it's not a conspiracy. I mean, this is a reality, certainly being driven by China. And what have we done with this tariff dynamic? We have pushed Vietnam to talk to China. We have pushed Korea to talk to China. We've pushed to Europe and even Japan. That China can't stand Japan. I mean, this is a history that goes way deep and is bloody and is nasty. And even Japan and China are talking on trade. This is kind of a dynamic that only feeds into of the push for a BRICS unit, which ties right into gold. Gold is a tier one asset, makes that a viable backing to some degree. Now, people also say, what's the U.S. going to go to a gold standard? We're going to have gold-backed bonds and all this. I'd love to think that that could happen. I just don't see how, because in my mind, and maybe I'm missing something, but in my mind, the only way you can do that is to revalue gold and to do it dramatically. Because while U.S. gold holdings might be seemingly high, relatively speaking, compared to the public debt, it's not that high.
Yeah.
You know, if you were to say we're going to, basically back the debt by gold, you might get us a year and a half worth out of it. As opposed to, look, we'll triple the price in gold so we can get the next president's term in or something like that. Really, if you wanted to do something like that and truly have some credible backing of either bonds or the dollar with gold, I mean, I hate to say where gold would have to be repriced. It would be 50,000 to 150,000. I mean, and that's completely unrealistic, obviously. And I know that people that are afraid that if something like that were to get a bigger push, you might be back in 1935 or 1930s where they're actually out there confiscating people's gold. And they would do that basically Barack Obama executive order, where they don't need a warrant anymore to go into safety deposit boxes in banks and remove precious metals that they might find.
Yeah. Yeah. Okay. Let me get your opinion on the dollar here. So here's the DXY. As a technician, I can't help but notice that we broke below what would have been a double bottom here today. So I'm glad we got you on the show today. What do you see? Is this bearish? Where's the next support level? Just go ahead and pontificate on this for a minute.
I'll tell you what, you should then pull up the chart I sent you on the dollar, because that'll give you a much longer term view and really give you the reality of what's happening with the dollar, besides just the kind of chart of the dollar index, which itself is extremely bearish. Because if you look, and again, this won't be in the chart you're going to pull up, so I'll let you pull that one up while I discuss this one. Well, okay. I'll talk to this one first. I like this. This is the gold adjusted value of the dollar. Pretty simple. Dollar index divided by gold. All right. Well, what it tells you, and it gives you this whole history. I have this chart that goes all the way back to 1973. And when you look at the 1973 dollar, we just broke below 3 cents on the dollar in terms of the purchasing power of gold compared to 1973. So when you take, I did all this kind of research too on, what was the rates of inflation and what is the dynamic with the dollar depreciation and all these different things, like the average rent in 1973. The most popular car was the Monte Carlo in 1973. What did it cost? People want to use the McDonald's indicator, the turkey dinner indicator, the suit indicator. All these things show, some level of inflation, but the best one is simply an ounce of gold. And when you look at it from this perspective, it's a great tell too as to the kind of the overall monetary conditions, which right now are kind of relatively loose, considering that they are pushing out debt and considering that money supply is rising and the dollar is now declining. So if you have the other dollar chart, I'm not sure I sent it to you, but that gives you the actual dollar index, and that is just compelling as hell as it speaks right now in like the last 2 or 3 months. Because again, what you have is a dollar bear market from 1983 through 2011. You have a bottom in 2011, at which point you rallied to the peak in 2022. ABC 22 high is a 50% retracement of the 81 to 2008 decline. So you're talking about secular long-term technicals that to me are almost too tight and too perfect to be real. It's like, if I wanted to draw a chart, I draw it up exactly as the actual chart looks of the dollar to give you what you have right now, which is a long-term secular breakdown from key technical levels that we reached, that should have been reached in this dollar rally and are no longer, apply. You've broken the uptrend line. It goes back to 2011. You have broken the 5-year moving average in the dollar, right? And the dollar now is down roughly 9% on a rolling 12-month basis. That's pretty big depreciation. Yeah. So that also ties back to the thought that inflation may have bottomed, which the inflation data is giving us clues that that's true too. So when you start to piece this all together, it suggests some kind of major low in commodities linked to this breakdown in the dollar that will bring inflation back at a time when the bond market's in trouble, the consumer's in trouble, and what's the Fed left to do? So you want us to think that gold can't push from here? We haven't even seen a speculative fervor in gold yet. And I say yet because it's coming.
Okay, so this chart is going back to if it continued on here, going back to 1973, it
Correct.
starting at $1, right? Now
Correct.
that
Yes.
purchasing power, that dollar is only 3 cents. Is that,
Right.
am I reading that right?
That's correct. I mean,
Okay.
take something like this is an exaggerated stat, but it
Yeah.
also kind of applies. All right. Let's take athletic salaries. I remember being a kid, born and raised New York, North Jersey, big Yankee fan all my life. When they stunk, when they were terrible, when they used to play the Cleveland Indians, the doubleheaders on a Sunday in Yankee Stadium, and they had 4,000 people there. We could all crowd around the box seats that cost $4.50. $4.50 for a box seat at Yankee Stadium. Think about it now. Let alone the salaries, where Mickey Mantle was the first guy to make over $100,000, and people went crazy. Oh my God, $100,000 to play baseball. That's insane. I mean, now you got, Aaron Rodgers getting $60 million to play quarterback for a single year. He's making over $1 million a week. Is that not a perfect evidence of what I'm talking about? The depreciation of the dollar, that a professional football player is making over $1 million a week. I mean, that is, come on, man. I mean, that's hardcore evidence, if you ask me.
Yeah, yeah, very, very good point. Radical inflation. Let me go back to the DXY here, and I didn't get that other chart
Okay.
that you
Sorry.
had, but I'll zoom out here, and you're talking. Where did you? Okay, so this right here on the chart is 2000 to 2001, right, of the
Right.
dollar,
That was
and
your
you
first
mentioned like
correction. Yep.
2011.
Yep. You had a double bottom, 2008, 2011. And then
Okay,
the
so from here
2022.
to here, the
Yep.
double bottom.
Correct. Yep. Double
Okay.
bottom. You had a higher low. So it was a
Yeah.
nice double bottom. And so
Uh-huh.
when you broke out in 2014 and 15, now here's an interesting stat for you. What happened in 2014 and 15 that caused it all to break out? The end of QE3. They
Oh,
stopped printing money. Stop printing money. Started QT. All right. And what happens? The dollar breaks out because now printing more of them. So
yeah.
now you're kind of on the flip side of all that. You saw now 2020 was a different case. The dollar broke, but then, you were talking about the whole globe was under pressure and everybody was doing the same thing. So that became a relative safety play. So you say that's kind of why the dollar didn't fully break down when they printed $8 trillion, between 2020 and 2021, which
Because you
caused
had
the
the rest
inflation
of
of
the world
22.
buying them.
Yeah, which then caused it. You got the inflation, which caused the Fed to raise interest rates. The U.S. interest rate premium over other countries skyrocketed and has supported the dollar ever since until just recently. So that was the 2022 high. You had a beautiful correction, by the way, right there where you see late 2024. You had it kind of came down, and you set up the levels down there in 2023 and 4 that you're breaking now. That was your support, and then you had a nice Fibonacci run to the 110 level late last year. That could have been the last time you might have changed this pattern, and it failed. Now, one more high over, right there. Yeah,
Oh, right here.
from that peak. Yeah, you were trying to make a run through that 115 high. You just failed, and that would have been the one time you could change this pattern. It failed, and I don't know what that yellow moving average is, but that probably the
That's
2-year.
200 weekly.
It is all right. So that correlates pretty well even with the longer term 5-year moving average. If you look at a monthly chart. So.
Okay, now which retracements? So if I pull up the fib here, and like this is down at
You got to go
2011.
back. You got to go back to, if you're going to do that, you really should go all the way back to the high in 1981, and then do the Fibonacci to the 2008 low.
Oh,
That's the Fibonacci. Yeah, there you go. Do that
1985,
Fibonacci.
right up there.
Well, do that one too. It also has Fibonacci numbers with the recent high.
And bring it
It's very
down
similar.
to like the
Yeah,
bottom
all the
here.
way right there. There you go.
Oh,
There's your 38, 50%. I
okay,
mean,
there's 38, there's
those are.
50.
Yep,
Okay.
exactly. So,
Huh. All right. Yeah, it couldn't quite break that. Interesting.
no.
Okay. Okay. Um, let's see. Okay, we hit the dollar, we hit silver, we hit gold, we hit bonds and yields. Um, you're a technical trader at heart. What is the most misunderstood chart pattern or signal you think that investors should be watching today?
Wow, that's an interesting question. I would say that one of the ones that I've seen, let's put it this way. I think one of the ones that has lost some of its value, not all of it, but some of it, is the more short to medium term head and shoulders patterns. Because so many
Oh,
people see them, so many people look for them. You'll get a break in the neckline, and literally 2 or 3 days later, you're back right up into the bulk of the pattern too. I like to think of more about what are the more reliable ones, which the exponential 2-year moving average for me is huge. The 200-day and 100-day exponential moving averages for me are huge. And when I'll tell you what, one of the most reliable patterns, besides when I see divergences in my proprietary oscillators, because of course I was quant before there was quant. I wrote algorithms in the 1980s that I still use today, right? But I'm not black box. I want everything. You say I'm a technical trader. I'm an everything trader. I'm top down. I'm technical bottom up. I'm quant, and I'm psychological position. And I really want the macro theme to encompass kind of all the trading themes that I might be putting in place. So it really starts at the top, and then I will trade it from the bottom up. And it really is mathematical, very much a risk overlay that is very disciplined. You have to be in this business. Like I said, if you can hit a baseball 1 out of 3 times, you're failing 65% of the time, still go to the Hall of Fame. So you have to kind of reset your mind in terms of that. But I love the patterns that I think are some of the most reliable patterns that are maybe misunderstood, that are maybe not even seen. Okay, is when you have a trend line, you violate the trend line, and you come back down on the back end. You get below the breakout pivot, but the back end of the trend line you hold, and then you come up and make a new high. That's one of the most reliable patterns. Extend that trend line and watch for the back end test. Either way, if they're breaking this one, it breaks down, it comes up, it tests the back end, might even be higher than the breakout point. And if it makes a new low, one of the most reliable trends ever. You're going to have a sustained move through that low if you get through it, or through that high if you get through it. So that's one I think that people are not so aware of. I don't think I've ever seen that in a book, but I use that one all the time. I have found that just by doing this for so long is one of the most reliable patterns out there.
Okay, interesting. Okay, so when the trend line, you extend it beyond where it goes and it breaks
Correct.
through it, it comes back
Yeah.
and tests it and then
Right.
and then drops
Right.
below,
Yeah.
that's the way it's
Yeah.
going.
That doesn't necessarily mean you're going to wait for that to happen, because sometimes it doesn't come back, and so you want to make, you're not going to miss the move waiting for the comeback.
Yeah.
But I would say if you like play the break and it doesn't work, and you see that play out again, maybe you get a little more aggressive and
Yeah, you can double
on
down.
the second time. Yeah.
Yeah.
So,
Yeah.
and I'd prefer to be early and wrong a couple times than miss any move. I mean, I
Yeah.
swear to God,
Okay.
missing moves that are coming, that are in the macro, handbook here in terms of what the theme might be, and missing that trade is much harder to deal with than a bunch of little losses or being wrong or being early or
Yeah,
anything.
you just
Or
keep your
drawdowns.
stop losses tight, and then you
Very
can
much
you
so.
can
The
you can
second
be
I put a position on, the stops are in every time. I don't, and that's funny because let's talk about that, because this might be good for some of your listeners. Putting stops in, right? Well, it's like I know how much I want to risk. All right, I want to risk half of 1% of my NAV on any given trade, let's say, and that's pretty accurate. All right. Well, I'm not going to go in there and say, okay, it's say on $1 million is our minimum investment, because I have to back engineer the risk, so I make sure my risk of ruin is low. And the only way I can do that these days, when gold contracts worth $350,000 and it can move 10 grand in a single day, I need $1 million to cover my risk metrics. So if my 0.5 equals say $5,000, okay, that doesn't mean I'm going to say, okay, I'm just going to go in and put a stop where $5,000 is necessarily, okay. Or have as many, whatever the contracts may be that I can put on. I'm going to say, where does the market tell me I'm wrong? What is my dynamic that I deploy, which is volatility based? Where is my stop at before I determine the dollar value and have any idea where that should be relative to where the price is? Where's my actual where I'm wrong position? Where is the real stop? That's what the stop needs to be, not where your money is out, where you're wrong on the market. All right. So in the case of, what if it's $25 in gold and I'm risking 5,000? That means I can buy 2 contracts. Okay. If it's $50, it means I can buy 1 contract. I back out the amount of contracts. Everything's back engineered from the beginning math. And it really starts then with what's the level in the market where I'm wrong. And then I back engineer it to see how many contracts I can buy based on the dollar value that I'm willing to risk. So I don't think that a lot of people do it that way. And frankly, you probably need a lot of money to do it that way, because these markets are so risky when you talk about the futures market, which is what I trade. But the same thing about the futures market is so beautiful. You have the platform right here on my computer. I click and buy and sell in instant. It's a 24-hour liquidity turnaround. It's regulated contracts. And what we do with our money management business is they don't give us money. They open an account in their name at one of our 2 brokers. All right. We have no access to the money. All right. Not only is the money held in this person's name, they can access it anytime they want. All right. But we go so far, and a lot of companies don't do this. Most of them, my competitors, won't do this. I give them a run from the broker. They can go into the portal of their own account and see it every single day. What's the P&L? What are the positions? What are we doing? What's the cash? I mean, it's total transparency. The only way that someone like me can do this with credibility. I'm registered as a Series 3, commodity trading advisor, and we are accepting new money. And I think that this behooves people going forward. For people in my industry, it's almost like I've waited 42 years for this exact scenario. And we really prepared for this by tweaking our whole program in 2018 based on what Jerome Powell said. And it has provided above average, really stellar returns since then, even after fees. And I think having long and short capability, being able to be in and out, being able to manage the risk extremely well, really behooves people to be able to take advantage of agriculture commodities, the energy space, the currencies. I don't know if I mentioned the Canadian dollar before. You look at something like Canadian dollar, it got crushed based on the political thing and the tariff war and the war of worlds, the war of words between Trump and Trudeau. All right. And what happened? The Canadian dollar got so out of whack with the price of the commodities it exports. There's a very tight historical correlation with crude oil. Right now, based on where crude oil is, Canadian dollar should be somewhere close to 85 cents on the dollar. And that's a big move from where you are, just above 70. So these are kind of opportunities that are out there now, that will continue to be out there when you say it's bearish in the dollar. Well, it's bullish for something else too, all right? Bullish the Swiss franc, bullish the Canadian dollar, even bullish the South African rand, which is all of a sudden in play. Why? Because now the dollar's down, platinum and palladium are breaking out, and the mining shares in Impala Platinum and Anglo Platinum in South African rand terms are exploding to the upside. So, able to take advantage of a lot of these different types of opportunities will only help you keep pace with the debasement that's coming next in the value of the currency.
Okay, awesome. Well, thank you very much, Greg. If people want to follow you and your work, how can they do so?
Some of those charts that we showed came from my Memorial Day bond market special, which is 60 pages of single page charts like you showed, easy to read. And I think that these are charts that everyone needs to see. I mean, honestly, it's like when you see something in that kind of format, it's much more visceral. It's much more kind of visible, frankly, to you. And when you go through the sequence of it, you kind of understand when you connect the dots where this is all going. It's almost undeniable when you look at the stats, the facts, the math, and the charts. It really is. So I would offer that to any of your listeners. We do offer a free trial to my research, which again is daily. We give specific recommendations in all these sectors with stop loss levels. It's really comprehensive. And from the macro top down, breaking down the data, frankly, like nobody else does. Looking at the inflation data today, it's like everyone thought this was benign inflation data. It was not benign at all. So we do that. For accredited investors who want information on the money management, any of that, email me at Greg Weldon, Weldon, Greg, at weldononline.com. We also do a podcast, which is found on Twitter at money_podcast. And then I'm on Twitter as well at Weldon Live on Twitter.
Okay, we will put your links down below. Greg, thank you for coming on the show. This was a real pleasure.
Yeah, my pleasure.
And thank you for tuning in. Go to stevebartonmoney.com for more and have a wonderful day.